Hi there, and welcome to this lecture summary for Managing Fraud Risk. In this session, we're going to briefly cover some of the fraud risk frameworks available out there, provided from the professional accounting bodies. Predominantly, we'll look at some of the key factors and key risks that you need to look out for, and then ultimately work out how a financial institution should really manage this risk and the process that they should follow. So first of all, here's a risk management cycle developed by CIMA, the Chartered Institute of Management Accountants. If you use the link, it'll take you straight to the document for this management cycle in more detail. But as you can see, it is a circular process. In other words, the risk doesn't go away, it might evolve, it might change. Therefore, you have to constantly be on top of identifying the risk and identifying how the risk changes. So the management within the organization must be mindful of identifying where risk may arise, the scale of it. Potentially, if it's a risk that doesn't need to be managed and can be allowed to happen, that is fair enough. But of course, external threats, so they have reputational or monetary value damage, then of course it needs to be managed. So following the cycle, you'd have to ensure if this risk is sizable, you need to develop a response. Whose role is it to do this? How do you know the response is being managed and controlled effectively? Is there a reporting procedure in place to acknowledge this happened, who dealt with it, and how it's been solved? So all of this needs to be considered by the management team or within an organisation, specifically the operational risk team. Here is another example of a framework from CIMA regarding fraud risk specifically. Obviously, the previous one was about risks in general from operational risk point of view. This one is specific to fraud, and fraud, unlike some of the other operational risks, does have kind of a legal aspect to it. It is a criminal offence in most countries to commit fraud. So you have the kind of legislative dynamic to this. For instance, fraud might arise via money laundering. Every financial institution has to have a money laundering reporting officer, and it's their job to ensure there's policies and procedures in place. If fraud or money laundering happens, they must note it, respond to it. If it's serious crime, they must raise that up to the country's regulatory authority. If this goes undetected or it's covered up, then the money laundering officer can face criminal prosecution themselves. So that's why the likes of fraud or money laundering is a bit more, has a legal angle because of criminal law. But of course, if it's not money laundering but it's fraud, then there is kind of the ethical point of view. In some places in the world, fraud might not be seen as a major offence compared to other countries. One may argue that in some cases it might be a victimless crime, so there's an ethics debate in there. From a management point of view, you've obviously got to have the right level of corporate governance in place. You've got to have the management to manage the risk appetite, to ensure that the right policies and procedures are in place, just like the frameworks we're going to talk about in this lecture. Here is another model, this time it's from KPMG, but ultimately you can kind of see the same words: prevention, detection, response. And it tends to be quite circular. In other words, it's non-stop. Because these risks may change, they may evolve. So this is just another example. Ultimately, a fraud risk assessment is about identifying possible risks, the probability, and the size of the impact, and then really prioritizing which is the biggest threat and putting steps in place to ensure this doesn't happen, or if it does happen, the effects are mitigated. A strategy, it needs to contain identification, the type of risk, type of potential fraud that may take place, whether it be internal or external. I said evaluate the likelihood and the impact. Again, can be subjective. The probability of something happening. We can use previous models to work out the likelihood, but ultimately it's just using historical data which doesn't predict the future. And as technology advances, the likelihood for external fraud becomes easier and easier than it has in the past as technology and the likes of cybercrime develops. And then lastly, you need to make sure that each threat is addressed properly. Either controls in place to prevent it from happening in the first place, or a response if it does happen. As you can imagine, strategies in different banks do vary. One size fits all approach doesn't work, so each bank will manage and mitigate its own risks based on its own previous experiences or shared best practice. Here is an example of a fraud risk framework from Deloitte. Again, very similar in a cycle process, but the language and the words are really already reflected in the conversation so far. If you have a look at this document, it explains their cycle in more detail. But ultimately, linking back to what you may have read so far on the theories of fraud, it really links back to the fraud triangle. So that being pressure, rationalization, and opportunity. From a business organization point of view, of course, you can manage, from staff point of view, the pressure. You can ensure staff training, the right HR policies are in place to ensure that pressure from staff or pressure that might make people commit fraud internally is prevented. From the opportunity aspect, opportunities are there if there's cracks in the system, if there's flaws in the policy, if the IT system's not up to scratch, then there's the opportunity to get in and do this fraud. Obviously that can be managed as well by having as watertight seals as possible. The thing that a fraud risk framework really can't address so much is the rationalization. And that's obviously very behavioural from the individual or the team that is conducting the fraud. How the psychology tells them that this fraud or this crime is worth doing for whatever reason. And that really can't be managed from the institution. So really the fraud risk framework is really about the blue opportunities here, but also it can be to reduce the pressure, certainly from staff in the event of internal fraud. So here's just a representation of the fraud triangle. Within your research, you may notice that this is rather old and there has been a range of adaptations. So we actually have the fraud diamond and potentially now the fraud hexagon. But what you'll see from your research is that this has evolved and other shapes have been developed with other kind of concepts that are built in. But this is the traditional theory. So how do we conduct a fraud risk assessment? Well, ultimately, it's looking at kind of worst case scenario. Of course, you can apply this framework to past examples and then use these past examples to kind of inform your future response if it was to happen again. But obviously from a bank point of view, they may look for what would be the worst case scenario to start with and then do examples of what's happened. So these are some of the questions that may be asked. Why might fraud persecutors exploit weaknesses in the system and control? Well, arguably because they can. If there is a lax in system controls, of course, it is there to be attacked. Is there likelihood for the perpetrator to override these controls? Well, internally, this could be done. If you give a member of staff too much power to control front and back office, for instance, no segregation of duties, then they could potentially override these controls without any questions, unless the management had proper procedures in place. And yes, can the perpetrator conceal fraud? Again, this really depends on the auditing. So if the internal audit is not done correctly, or if the perpetrator's done profit smoothing and this is not spotted, then this could be potentially concealed from management. So really the auditing team needs to ensure that it has full access to the data within the organisation to conduct this fraud risk framework. Before an organisation conducts this fraud risk framework, the management obviously need to set out the rules of this fraud risk framework and need to delegate the tasks to the appropriate team. So we need to obviously work out the scope of the work, who will do the work, how will this work be conducted. If you want to kind of interview or survey your employees to see if they know any potential system issues or any kind of cracks in the armour that hackers can get in, then you work out how that will done. If this sort of quantitative or qualitative data is collected, who will process it, and ultimately who will produce a report to then create the assessment. So that all needs to be worked out by the management team. When you create the team, of course you need a multi-dimensional team that involves people from all parts of the business. You'll need your IT specialists, you'll need your operational risk manager, potentially the money laundering officer, you'll need HR, and also you'll need people that use the system day to day, because they'll be the best people to know whether the computer system they're in can be hacked. The people at the front line will be able to see where external fraud may arise and how easy it may be to conduct. So it's not just the management looking down, it's more gathering data from real specialists within the organisation to enable them to create this fraud risk framework. But obviously, it really depends on the size of the organisation, the reach of the organisation. Do they do this on a country by country basis, or do they do it from an organisational point of view? And this again will depend solely on the business. And as just noted before, really how does the management create this framework or collect the data to know where the cracks are? Of course, it's really a combination of different methodologies. There is no one-size-fits-all approach to this. Each methodology, whether that be a mind map, interviews, focus group, surveys, they all have their own advantages and disadvantages. For instance, on surveys, who will fill out the survey? Will it be someone that really supports the idea behind creating this framework? But the people that don't fill out the surveys are because they can't be bothered or they don't see it as important. So there's kind of like completion bias in some of these techniques. But ultimately, the management need to kind of bring their employees along. They really need to promote the benefits of doing this. Show their employees that, look, we take this seriously. It's not just an extra burden on you guys to ensure you you follow the regulations, or you comply with your compliance team. You really need to bring your employees along on this and make sure it's everybody's job within the organisation to ensure this doesn't happen. So I'm going to show you a kind of basic fraud risk framework that is a simple table that kind of follows these 8 different steps. And throughout each step, I'll briefly elaborate on them. But hopefully they're quite obvious when you see the table. Before I get there, I'd just mention there is obviously this one here from Deloitte is very similar. It does have kind of similar steps, but this is type another fraud risk framework based on the 360 approach they outlined that I showed you previously in this presentation. So here are the 8 steps. You have your first column, which is the potential fraud problem, the potential risk, and this could be anything. For instance, you might have the LIBOR rigging scandal being a fraud risk scheme, because ultimately it was collusion between Treasury Department workers within the banks. You have likelihood, then significance. People what controls were there in the first place, how effective were they, what potential residual risks were there, was it just a lone individual, or was it something management didn't spot? And then there is obviously the response at the end. So I'll go through each one in turn. So the fraud scheme, as I've said, this could be, normally it's like a worst case scenario, but typically we'll do this on past examples. And this is kind of a range of different examples. They could be from quite minuscule examples like a receipt fraud up to something that is more substantial, just like the bankruptcy related frauds. So you've got a wide range of different fraud examples, and each one of these is a link to an appropriate website to show you more and give you an example. Obviously within this, just think about the likelihood of the types happening, what was the incentive, the pressure, the opportunities, linking back to the fraud triangle. Likelihood, so obviously looking at each example in one by one, what was the probability of that happening? Can this happen all the time? So simple kind of receipt fraud is probably quite probable. It's probably something easy to do. It's not that difficult for any individual to kind of make fake receipts. But obviously bankruptcy kind of fraud, well, you have to have a business in the first place. Not everybody can do that. So there is some crime is very easy to do, some quite straightforward. Think about the country we're in. What is the fraud regulations in that country? Typically, if the fraud regulations are really strict, they're less likely to commit fraud. But if the legislation is quite loose, then fraud may be more probable. So it's kind of them aspects as well. Now, likelihood is very subjective. There's lots of different words you could use, like probable, reasonable, improbable. You could put into a percentage in the form of a number, but ultimately this might be based on previous data, but in some cases previous data does not exist. Therefore, it is a very subjective call on the likelihood. For instance, the LIBOR rigging scandal, the likelihood of that would have probably been very low originally, and it's only ever happened once. So there would be no historic data on this. Here is Deloitte, and in partnership with a operational risk management firm. They kind of give you an idea of the language to use on a rating of 1 to 5. So they're like less than once in 100 years. You could argue the LIBOR rigging scandal would have been between a 1 and a 2. But likes of check fraud, that could happen quite often, up at 5. So here's just a kind of defined scale if you need one. Obviously, significance to the organisation being the third one. Now, like if it's a simple like check fraud or receipt fraud, it's probably not that significant. But something like the LIBOR rigging scandal, that had large fines, reputation, certainly to like Barclays, really took a hit. So it's not just kind of monetary significance, it's also reputational and obviously legal. So, there was prosecutions brought to people involved with the LIBOR rigging scandal. So the significance can be very minuscule to non-existent, all the way up to ultimately losing the banking license, which could happen in severe cases of money laundering. Banking licenses could be revoked and there's your bank loan. Again, here's another, using the same document, here is a scale from kind of incremental all the way up to extreme loss. Just gives you some more examples there. Obviously, this is not always a monetary issue. As I said, it could be reputational. So really, it depends on how you calculate significance, whether you just kind of convert it to a monetary value, or if you you kind of look at the qualitative kind of significance as well. And this is where some of the words like immaterial, significant, and material come into place. Where there is no monetary value, then obviously you can look at two different techniques, more of a quantitative or a qualitative technique to work out the significance. Each technique to work out the kind of significance, there are both advantages and disadvantages of this, as you can see again from this Deloitte document. The similar document also kind of rates significance from the kind of high to low, and that's obviously again from impact and impact on the Y, likelihood on the X. But as I've noted in a previous recording, high impact, high likelihood, really these, you shouldn't be in a position where this should be available, otherwise the institution will not survive very long. That's why the BIS prefer the kind of triangle braced, where you'd have high impact but low likelihood. It's more of a triangle than this matrix. Number 4 is about the people. Who did it? Was it external or was it internal? So looking at a specific example, then of course you can determine who it was. Probably not by name, but by department you could. But if you're just doing a hypothetical, worst case scenario, then you have to look, could it be internal? Could it be external? Other ways to prevent this from happening. For instance, if it is for internal, what kind of training is there in place about this risk? Is there kind of tracing of people's computer habits? For instance, front office traders, typically the whole room is bugged, so every conversation is recorded and there is video cameras, for instance. So what mitigating steps can be put in place to prevent internal fraud? And from this point of view, if you're looking internally, you would potentially, there is a trade-off of how much control you do. So if you spend a lot of money putting all these steps in place, have you spent too much? Is this an overreaction? Because at the end of the day, this fraud risk framework is a cost-based exercise. It's not revenue driven. You have to do all this to produce this framework to make sure it works. It's a costly exercise. Obviously, the cost is hopefully would be outweigh any sort of impact if fraud was to happen and it wasn't managed. That loss could be much greater than the cost it is to maintain the fraud risk framework. But from an internal process point of view, you need to look at which business unit, which department, or which individual is likely to have the opportunity to conduct this fraud, and really target the mitigating processes to these staff and the kind of physical hardware that they're working with. Section 5, this is already looking at, has the business or organisation already put the steps in place to prevent this risk from happening? If so, are these steps good enough? Are they up to date? If it's from a technology point of view, do they take into account recent advances, or there's been new bolt-ons added to computer systems? Have these been taken into account? Is there current policies and procedures in place? Are they strict enough? Is staff training up to date? All of these things are kind of looking at the internal controls that already exist and whether they're applicable moving forward or in the event of a worst case scenario. So also think about the kind of the distinguish between the two types of controls, saying the preventative, stopping it from happening, and then also the detective, to then identify. So it's not just looking forward, it's also potentially looking back. What steps are in place to prevent this from happening in the first place? But also, what do we have in place to identify fraud if it does happen? And make sure there's a good balance between the two and that they are complementary. 6 is all about assessing the internal controls, their effectiveness. Now, this effectiveness does link back to kind of a legislative process. Obviously, the likes of the Sarbanes-Oxley Act in the US. Then let's consider this makes sure that organizations do review, monitor their processes, make sure they have internal controls. Now, effectiveness, this really can't be tested until it's happened. So for worst case scenario planning, you might not know how effective it is, but I suppose from previous examples, you can work out how effective some controls were in place to prevent such risk from happening. Within this framework, to assess whether the internal controls work, again, it comes back to cost-benefit analysis. How much do you put in place versus the likelihood and severity of the risk happening in the first place? Whose job is it to do? Is it the risk management teams? Is it individual department manager's job? So there is a range of different ways you can look at how effective the current internal controls are. Now obviously, if it's a big previous example you're doing, then clearly the internal controls may not have been that effective, given that you're demonstrating something that has happened that has been significant. So you might want to comment on why the internal controls were not adequate in your example. Following looking at the effectiveness, you need to then consider residual risk. Now this is the assessment of whether the certain risk types cannot be mitigated adequately. So some instances, you may have all the controls in the world, but you still can't prevent that one lone rogue trader, that one individual, that manager. You can try and put as many controls in place as possible, but you can't account for the behavior of an individual or a certain group of externals, in the case of external fraud. So really it's kind of looking at how you could potentially eliminate this risk. And this could say, from an employee point of view, it obviously goes back to recruitment, making sure you're employing the right people, following the likes of fit and proper. Are they member professional bodies? Do they have the right qualifications? So on. And it's about ensuring that you don't have that pressure aspect within the fraud triangle. And also think about, from a management point of view, make sure one manager doesn't have sole control. Make sure there is a distinguished process and kind of a number of checking points for individuals in management to ensure that not one person can have capacity and responsibility for, say, one computer system. Make sure this risk is spread amongst a number of colleagues, and also ensure you have the internal auditing team is making the right checks. And lastly is the fraud response. Now obviously this is really how to react, not just kind of putting right what went wrong, but also learning from that response and reporting it, ensuring you have a correct audit, a correct diary of what's happened, when it happened, who did it, just in case the regulatory body in the said country might ask for this, might request it. In some cases, this might need to be publicly disclosed in the annual report or the annual general meeting, depending on the severity. Obviously, the fraud response, again, there's loads of different diagrams or procedures laid out by different organizations. When you respond to fraud, if there's a legal aspect, then of course you might have to get the body from that country, say whether it be the police or serious fraud office, might need to get involved. But ultimately, it is the organization's responsibility to ensure that they respond accordingly and it is managed appropriately. And if there is customer loss involved, that is customer loss, there is redress for this. And this guidance will also come from the regulator of the jurisdiction involved. When it comes to learning and responding, if you don't have controls in place, you probably think, okay, what can we do? Where was the lack? How did this occur? Going back to the internal controls, make sure them internal controls are a bit more watertight than they were before. and then whether that needs more training, different management structure, new segregation of duties, but then also thinking about what kind of looking forward can happen again. How can we be more proactive in the future? Can we spot this sooner? And that sort of thing. Another example could be a whistleblowing policy, where most organizations have a direct line where they can really call or report anonymously to the auditors in that organization or even the management to acknowledge this is happening. Now, from a UK point of view, under FCA, whistleblowers are protected. So if a whistleblower comes out and says whatever's going on, they're protected by law. They can't be sacked, they can't be discredited, they can't be kind of managed out or silenced. If it's found that a whistleblower in the UK has been treated poorly or they may have lost their job, then this is a real serious offence under the Financial Conduct Authority, and the Financial Conduct Authority actually have the power to remove a banking licence if a whistleblower is marginalised. So, from a UK point of view, whistleblowers do have a lot of protection. In other countries, for instance the US, whistleblowers can actually be paid to do this. They can actually receive monetary reward for whistleblowing, but they don't have the same protections. But then that also brings an ethical dimension in debate. Should you be rewarded for whistleblowing? In the UK, whistleblowers are not rewarded because it's seen as the right thing to do. They're being ethical by reporting such a problem. But in other countries, you do get financially rewarded, but might not have the same protections. So there is a bit of a trade-off when it comes to whistleblowing and ethics. And lastly, you might want to also have a backup procedure in place. So where there is an IT system, you obviously would have like a backup generator, backup storage unit. If your whole system goes down, is there a mirror system elsewhere that everything can jump straight onto? So it's kind of also thinking about the kind of high level infrastructure backup issues that you might want to put in place as a risk response for future, or as an even an internal control point of view. So I hope that kind of summarizes what a fraud risk framework might look like. Now obviously what you see on the screen is very basic. It's using the words from the CIMA and the operational risk management company document. It's just kind of the remote material, that sort of language. That's where it's coming from. But really a fraud risk framework is much bigger than this. Really each row would be a bit more detailed, like a probability, a likelihood. You might want to elaborate on why it's kind of probable, why it is significant. If it's past examples specifically in the fraud scheme, you'd have a bit more detail, i.e. the dates with the department, then you'll probably know who was involved, for instance. Technically, you might not know them from an external looking in, you might not know the effective control element, but you can potentially suggest where the lacks of what controls they should have had in place, or potentially in the residual risk, why the controls failed. So this is a very basic fraud risk example. Really, if you have to conduct this, it will be significantly different. There'll be a lot more text, for instance. Thank you for watching this summary video.